Morning, good afternoon, and good evening, and thank you guys once again for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson, founder and CEO of 9 Innings Capital Group. Thank you guys for subscribing to the channel, the YouTube station here. Thank you guys for getting the book MLB to CFP. We're still getting great demand for the book. If you guys want to listen to our podcast, listen to our YouTubes, go to our iTunes platform. You can reach that via our website, www.9inningscapitalgroup.com. You can also read our blogs, our weekly blogs we have there as well. And today I bring that up because we are going to be talking about one of our blogs. We're going to be talking about markets being at all-time highs. Where do we go from here? Well, I'm going to tell you this. Where we go only matters based on three concepts. Yes, I'm saying three concepts here. 1, wage growth. 2, inflation. 3, interest rates. Let's get it. It will be dictated by a couple of different things that happen, a couple of different measuring points in our economy. 1, let's start with here, wage growth. We are seeing some wage growth. You're seeing the government come in and implement some minimum wage requirements. We have $15 minimum wages in some parts of the country. We also have the labor force flexing their muscles at this point, and they're saying, no, we're not coming back to work without higher wages. You also have the labor force saying, you know what? Not only are we not coming back unless we get higher wages, we are demanding a hybrid model. We want to work from home. We want to work at the office. You can't force us to do this. We want this amount of money, and we want this amount of flexibility in regards to our employment. So right now, the upper hand is in the labor force. And when the upper hand's in the labor force, guess what happens? Wages increase because you have to entice, as a business owner, I have to entice an individual to come and work for my company. So one thing I'll always say is that there are some transitory measures to inflation, to some of the inputs. But wage growth is not one of them. Wage growth is one of those things that remains permanent. That job may go away in the future, may get automated, but it remains the fact that that job is receiving that level of currency. That currency won't go down. So wage growth is permanent. Wage growth is here. Now, how can we get labor, supply and demand to come back to equilibrium? You guys remember that in finance class, right? You had your supply curve, demand curve. They get right here. You have your equilibrium price. How do we get that to come back in the equilibrium? Well, of course, when you raise prices, ultimately, the curve may shift left or right, depending on how you're looking at it. I don't know what angle you're looking at it from my perspective. But the reality is that prices are increasing, and when prices increase or decrease, there's either a shortage or a surplus. A surplus of labor or a shortage of labor, right? Vice versa. When wages go down, there's going to be a surplus of labor because people are no longer going to work for those prices. Wages go up, there may be a shortage because you're not going to hire as many people. So, we have to consider not only wage growth in regards to our current situation. I believe I said that last part right. We can always change it out. Everything in my life is vice versa, by the way. So we talked about wage growth. Now we're going to talk about inflation. This is the second core component. Inflation may be transitory. Wage growth is not transitory, like I mentioned before. Inflation may be transitory. You've seen oil prices. OPEC came out. They had a big meeting. They said that we're not going to come to an agreement. Boom, prices were around $75 a barrel. They came down. Right now, today, as of today, they're in the 60s, low 60s. They had a huge poor week last week. The world is flush with oil at this point because there's very little demand at this juncture. Remember what just happened. COVID happened. There weren't planes flying in the air. There wasn't people traveling. There was less and less demand for oil. So now oil is abundant. But what you also don't understand is that there's a natural depletion in oil. When you store it, it naturally either evaporates or just depletes. There's portions of oil that naturally go away. So that's good for the oil markets, right? But it's bad for the oil markets because the demand is not there from the planes in the air, from the ships in the sea, from the factories moving, turning labor, turning products and widgets. But we will get back there. We will get back there. But right now, in regards to inflation, you're seeing it in meat prices, oil prices, gas prices, things like that. Why? Because the Federal Reserve maintains a low interest rate environment. With lower interest rates, there comes spats of high inflationary markets just very, very quickly. You saw it in lumber. Lumber went up almost couple thousand percentage. Copper, a lot of the commodities went out of control. Inflation was very, very heavy in those markets. Housing prices. When lumber goes up, housing prices went up. So we saw these different dynamics in our economy. So when that happens, guess what happens? Sellers come out and say, hey, I want to sell my house. Buyers come out and say, I want to buy your house. They buy your house at inflated prices, changes the markets. All the markets change across America. And now you're seeing, especially here in Texas, that we have very, very high housing prices, which basically means what? When it comes down to tax time, higher appraisals, higher taxes. So inflation is definitely something you need to consider. So 1, wage growth. High markets right now, wage growth. 2, inflation. Need to stick with inflation because why? Because the next one's going to be interest rates. If inflation gets out of control, if inflation does not remain transitory, the Federal Reserve will come in and raise interest rates. They will have to, because they will have to raise interest rates to slow down inflationary pressures in pricing. But what happens when they raise interest rates? When they raise interest rates, that slows down the economy. The Federal Reserve cannot afford to slow down an economy, even though we're running hot right now. But you can't afford to slow down an economy that has such question marks behind it. Where do we go with the Delta variant? Where do we go with the Lambda variant? Is that going to give us a second, a third, fourth, fifth, sixth wave? We have to remain hot and let the car run, to give you a F1 term, to let the car run hot. Then what we can do is when we get on a straightaway, we can raise interest rates to cool down the brakes. Raise interest rates to slow down the economy, to bring it back to where it doesn't overheat. Why is overheating such something that we don't want? Because if it overheats, that means prices get out of control, and we have to raise interest rates so high so quickly that just destroys markets. When interest rates move up, it becomes less and less likely to lend to companies. Other small businesses can't open up because they have tougher lending standards. Harder to get homes and things like that. So it becomes very, very difficult situation where you slow down the overall productivity in the market. So with markets at all-time highs, where do we go from here? Like I just mentioned, well, we have wage growth. If wage growth remains consistent, then ultimately that may lead to inflation. But inflation being transitory at this current juncture, even though wage growth, like I mentioned to you before, is not a transitory measure, we will raise interest rates to combat inflation. So these are the expectations. So how does that impact the market, you ask? Kevin, I want to know, how does all this impact the market? Well, it impacts it this way. If interest rates move up in a very, very slow manner, it will not impact the market substantially. It will impact bonds, fixed income. Depending on what your duration is in your fixed income portfolio, it will definitely impact that, because what do we know? Rising interest rates, bond prices, they're inversely correlated. So what we know is that it will affect your fixed income. That's okay. It will impact securities pricing as well, because when your discount rate, which is the interest rate, or your risk-free rate, moves higher, equity prices have to offset that and come down just a smidge. It's all about the risk-free rate. If your risk-free rate goes up, your discount rate goes up, it's capital asset pricing model 101, then the equity pricing, your rate of return that you're going to suggest that you're going to need to get in the market has to increase as well. And then your multiples are going to have to basically get expanded. And ultimately, are you going to pay that expanded multiple for that security price? Absolutely not. And the pricing needs to come down to get to more of a multiple that you're willing to pay. Interest rates, inflation, wage growth are all important segments of this market right now. So be on the lookout for that. If you have questions on that, please go to our website, www.980scapitagroup.com. Go to the top right of the page and go to the email and type in, go to the email at 980s@9icapgroup.com. Submit your questions. If there's some things that you have questions about commentary, please submit those questions, comments, or concerns. We can get those answered to you as well. And again, thank you guys for all the commentary and questions. If you feel free to reach out to us, 682-233-7773. We will take care of you and get your questions answered. And if you want to schedule an appointment, go to the website, www.980scapitagroup.com. Schedule an appointment, and we can sit down and have a conversation as well. Hey, stay humble, stay blessed, and you always know we're here to do what? Educate, empower, and engage. Thank you guys for listening to 980s Capital Group. Stay humble, stay safe.